My stock portfolio is currently up 11% in just the last month, which puts it up almost 100% for the entire year. In this video, I'm going to reveal my now over $200,000 stock portfolio and show you what I invested in to achieve those gains. Hey everyone, and welcome to FinTech. In this video, I'm going to walk through each stock position that I hold, show you exactly how much money is in each position, and talk about why I own the companies that I invest in. At the end of the video, I will also talk about any stock trades that I made in the past month, which totals 5 trades, including 2 completely new companies that I have not talked about before. And for full transparency, the portfolio I will show you does not represent my entire stock positions. I also have a 401k where I just invest in passive index funds that track the market. Although even though I put way more money into my 401k, it's not worth as much as this portfolio just because I've outperformed the market so much over the last 3 years. So hit the like button if you appreciate me showing you basically every detail I can think about with my stock trades. I do it because I want to be transparent and I think some people might get a benefit from it. But let's not waste too much time and let's pull up my brokerage account and start going through my individual stocks. So I have pulled up here my Charles Schwab portfolio, which I use because I can actually pull in all my different stock accounts into just this one account to view everything all at once. So you can see here in just the last month, I'm up about 11%, but if I expand this to my year-to-date view, the year's been pretty rocky so far. I started out going up until around February, after which we saw kind of a minor market crash in software as a service stocks, and then the portfolio grew again through April before crashing really quickly in May, before growing pretty steadily from May until now. And if we expand this all the way to a 2-year view, we can see that I'm up over 600%, although that does include me also adding some money into this account. And you'll notice a couple points along here. So for example, back in October 2020, you see this little dip in the portfolio right here. Well, at the time, that was a major crash in my stock portfolio. But if I had sold out at that point, I would have missed the entire bull run leading up until March of 2021, when again, we saw a pretty major crash, but again, it recovered. And now we're up to where I am today at over $230,000. So the lesson there is don't sell unless you have a fundamental reason to sell, even if the stock price is dropping. So now if we scroll down some more, you can see these external accounts here as well as my Schwab account. So what we're going to look at is a combination of these 2 accounts. Now the Schwab account that I hold is taxable, while the external account in Vanguard is a Roth IRA, but we'll talk about that more later. Let's first get into the actual stock positions that I hold. So the first position we're going to look at here is CrowdStrike. Now CrowdStrike is the largest position that I hold in my portfolio. I currently have 194 shares in the company valued at over $50,000, and in total, those shares have made me $33,500. Now, I actually sold some of my CrowdStrike position, I think 2 months ago, and so that gain and loss is actually less than the total I made in the company. But even so, you can see here my cost basis, which is how much money I invested into the company, is roughly half of my gain and loss, which means that my gain is almost 200% what I initially put in. Now, CrowdStrike is a security company, and in my opinion, they have the best security products in the world. They're also growing extremely quickly, and they are cloud native. So as we see more and more companies move into the cloud, CrowdStrike is positioned extremely well to gain a lot of that business. Plus, on top of that, they're still winning over traditional security customers. So really, this is almost the perfect company for me. My next largest position is a company called Datadog. I own 362 shares in this company at around the same amount as CrowdStrike, so $51,000. And in this company, I originally invested $22,000 and now it's up $29,000. So again, this is over a 100% return for the company. Now what Datadog does is try to make it easy for business leaders to view their security, their applications, and their infrastructure all through a single pane of glass. That way they can essentially monitor how the business is performing in real time. And as we see a proliferation of new data being generated from IoT devices, real-time tracking, and just the ease of storing data in the cloud, Datadog is going to experience even more growth going forward. My third largest position is probably the company I've talked about the most on this channel, and that is Cloudflare. Cloudflare is currently a $47,000 position for me, and again, it's over a 100% return, returning over $26,000 off of a $21,000 investment. Cloudflare is seeking to make the internet itself work better. They started out as basically just a CDN service hosting websites, but then they realized that by hosting websites, they could then optimize the web experience for good actors while also blocking bad actors from accessing those same websites. From there, they've expanded into a whole suite of products which are all best in class. And Cloudflare also has a unique inverted sales funnel where customers actually reach out to them, use their products for free, and then once the customer is locked into the ecosystem, Cloudflare will then spend money expanding them to sell more and more products to them. And companies are happy about this because the products work really well. Now you notice that each of these companies have a 2 next to them, and that's just because I hold them in 2 different accounts, both my taxable Schwab account as well as my Roth IRA account in Vanguard. The reason I use a Roth IRA is because all of those gains can grow completely tax-free, which means that I'd never have to pay capital gains tax on them. Versus in my Charles Schwab account, I have to pay either a short-term capital gains or a long-term capital gains. But now moving on to my next batch of mid-size position. The largest of those is a company called Upstart. I currently own just over 100 shares of Upstart at a value of $27,700. And this company I've only owned for around 2 months, but it already has an almost $13,000 gain on top of a $15,000 investment. So I'm getting close to almost a 100% return in 2 months. Now, of course, Charles Schwab is giving this stock an F rating, but even when I bought the stock, they were giving it a D rating. So these ratings here really don't hold any value for me. Now, what Upstart does is use AI to make lending more efficient. While traditional companies will look at one number, a credit score, to determine whether or not you're ready for a loan, Upstart looks at a whole array of numbers to try to determine that using an AI model. They incorporate over 1,300 parameters to get the most accurate view of somebody who's trying to get a loan. So what this allows them to do is A, offer more loans to people who might not qualify under a traditional credit score, or B, offer loans with lower interest rates to people who might have a decent credit score, but secretly they're actually a much better lender than anybody realizes. This is allowing Upstart to grow extremely quickly, both by offering loans themselves, as well as by white labeling their tool and letting other lending companies use it as well. The other big advantage here for Upstart is because they're using AI, as they offer more loans, they're going to generate more data. And they can feed that data back into the AI algorithm, which will create a flywheel effect where the algorithm becomes even better, which results in more customers using the product, which again generates more data. Next up, we have ZScaler, which is actually a new position in my portfolio this month. Now, I currently own 60 shares of ZScaler valued at $16,000, and it's basically flat since I first bought it. I put in $16,500 and it's lost $200, so no real change there. ZScaler, kind of like CrowdStrike, is a security company, but with a big focus on a zero trust platform. They make it so you can connect different apps within your ecosystem directly without having to trust the other apps. So one way they describe this is kind of like an intelligent switchboard, where you can connect users to apps, apps to other apps, IoT devices to your cloud, and not have to worry about the security infrastructure that's running both of those items. Which is why they say it works over any network and at any location. And I think that we're going to see a lot more shift toward a security-focused thinking as more people move to the cloud. So again, ZScaler is probably going to benefit from that as well, which is why it's now one of my, I think, top 6 largest positions in my portfolio. Next up, we have ZoomInfo. ZoomInfo is currently just over a $10,000 position for me, and it's up just $600 from the $10,000 I first invested into it, which is actually a drop from where it was last month. ZoomInfo makes it easy for salespeople to connect with people in companies who can actually use their product. So it provides benefit both to the salespeople because they can reach people more easily as opposed to going door to door, and it helps the people in the companies because they can connect with products that they actually need. This is just a mid-level position for me because I still haven't done a full deep dive into the company, but they are growing really well and all the fundamentals look pretty good. After that, we have kind of the last of my mid-sized positions, and that is CLMited, which is currently just over a $7,000 position for me off of an initial investment of $5,500. So it's up $2,000, which is pretty good. CLMited is kind of 3 companies in one. You have Garena, which is their gaming business, which is probably most famous for Garena Free Fire, which is the largest mobile game in the world. They also have Shopee, their e-commerce platform, which is the biggest e-commerce platform in Southeast Asia and is also growing extremely quickly in Brazil and Mexico. Finally, you have C-Money, which is essentially a fintech company. So when you put all of these together, you can kind of think of CLMited like the Amazon of Southeast Asia. They have a really interesting model where they get really embedded into one region's culture, then expand to take over the whole area. They've done this in Southeast Asia, they've done this in Brazil, and they're starting to do this in Mexico. If they can have this same success as they continue to spread outward, this company may actually be able to compete with the Alibabas and the Amazons of the world. They're growing extremely quickly, and the only reason they're not a larger position for me is because of the e-commerce aspect and just understanding how brutal the e-commerce industry can be, especially when you're competing against companies like Amazon. So then we move on to some of my smaller positions, the first of which is GlobalE. Now, GlobalE is currently a $7,500 position for me off of an initial investment of $6,800, so it's made about $700, and that's only having held the company for, I think, 2 weeks at this point. GlobalE also operates in the e-commerce space, but more on the technology side. They make it easy for customers in one country to sell to customers in another. So, for example, a customer in Europe selling an item to someone in the United States. Now, you have other companies that operate in both of these regions like Shopify, but Shopify is really good at domestic service, so US to US or Europe to Europe. They're not as good at crossing that barrier. GlobalE makes that a lot easier, and they're actually working with companies like Shopify to make it easier for them. This is only a small size position for me for now because I have not done a full deep dive into this company, but that's probably going to happen relatively soon. After GlobalE, we have DocuSign, which you've probably already heard of. DocuSign is just over a $4,000 position for me, and off initial investment of $3,000, it's made around $800. Now, DocuSign is the leader in the e-signature market, and traditionally they've completely dominated that market. In fact, nothing really looks wrong with the company. The only problem is I'm very uncertain about their future ability to grow. Once you completely dominate a market like e-signature, how do you achieve the same success a second time? Sure, they're offering new services like their e-notary service, which makes it easy to notarize documents online, but that's not going to have the same impact that completely revolutionizing the signature market had. And unless they have some kind of major product breakthrough, this is probably going to stay as a small position for me. After DocuSign, we have Tattooed Chef, which is a $4,000 position for me, and it's lost around $200. Honestly, I only held this stock in my portfolio for around 2 weeks, and I've actually already sold it. It was in my Vanguard account, and I think Charles Schwab just hasn't updated yet. So I'm not going to talk too much about this company because it's already gone. Next up, we have Snowflake, which, if you remember, used to be one of my largest positions. Snowflake is currently a $1,200 position for me, and it's made $189 off an $1,100 investment. And I basically have sold out of Snowflake at this point. Snowflake is probably the fastest growing company on this list. What they do is offer essentially data management as a service. So while a company could go to a cloud provider like AWS or Google and build a whole bunch of different data wrangling services and storage things on that platform, that takes a lot of effort and a lot of expertise. Snowflake offers all of that as a service. The only problem is because they've been growing so quickly and they have so much hype around them, they're an extremely expensive company. Now, traditionally I held them anyway because if they kept growing long enough, they could eventually outgrow that valuation. The only problem is I'm not as confident that they can keep growing at the same rate going forward, which is why I've shrunk this to such a small position now. Finally, the last and smallest stock in my portfolio is SOFI. I own 30 shares of SOFI valued at just under $500, and it's made me about 35 bucks off of a $430 investment. Now, SOFI is a fintech company, and they operate in a whole bunch of different areas: lending, financial services, and their technology platform. Their goal is to essentially compete with traditional banks and get rid of all the inefficiencies of the old banking system and move it into the 21st century. Right now, they're using their financial services, so platforms like SoFi Money and SoFi Invest, to grab a bunch of customers and then funnel them down to their more valuable services like SoFi Lending. This has been working pretty well for them so far. They've grown 89% since 2019, and this is just a small position now to keep the stock on my radar to decide whether or not I want to buy this up to a full position or just sell out of it. Now, during that review, I didn't really talk about PE ratios or price to sales ratios on any of these companies. Now, I didn't talk about PE ratios because a lot of these companies have negative earnings, so it doesn't really have any meaning. In terms of price to sales ratios, some of the more expensive stocks on this list include Upstart, obviously Snowflake, which I did talk about, and then CrowdStrike, Datadog, and Cloudflare are all relatively expensive too. The thing is, even if a company is expensive, high enough growth can make up for that. So let's say your average company has a price to sales ratio of 15. Then you have CrowdStrike over here, which has a price to sales ratio of 40. But at the same time, CrowdStrike is growing at 70% per year. So 1 year from now, if the stock price were to stay the same, their price would be essentially 70% cheaper. Then the year after that, it would be 70% cheaper again, 70% cheaper again. And as long as they can maintain a high growth rate for a sustained period of time, they can catch up to the price to sales ratio. So the real bet with these companies is A, can they maintain their growth? And B, can they maintain it longer than Wall Street expects? If both of those two things are true, these companies' stock prices can appreciate extremely quickly because just one extra year of 70% growth would essentially equate to a 70% increase in the stock price. Now, the last thing that I promised I would talk about are any trades that I made in my portfolio this month. And there were 5 total trades. So I've kind of alluded to 2 of those trades already. I shrunk my DocuSign position, so I sold around $5,000 in this company. I shrunk my Snowflake position a lot, so I sold about $15,000 worth of Snowflake, and I completely sold out of my temporary position in Alteryx. And if you want to see the reasons for that, you can look at my old stock portfolio review from last month. In terms of buying, I had 2 new companies which I added to this month. The first was GlobalE, and then the second was ZScaler. So between these 2 companies, this is where pretty much all the money from selling out of my other positions went. And my main reason for selling those other companies was just to free up cash so I could invest in these companies, which I think are going to perform better. Even the companies on this list, which I don't have a high conviction in, I think are probably going to have positive returns. The real question is, can I deploy that money from a lower return to a company where I think it's going to have a higher return, like ZScaler? And by the way, I mentioned that both ZScaler and CrowdStrike are security companies, so I'm probably going to make a video comparing those 2 stocks at some point in the next month. So make sure you're subscribed if you want to see that. Don't forget to like the video, and I'll see you next time.